Internet hype frames rental properties as the ultimate financial flex, while index funds are the quiet strategy running in the background. These two investors, Jake and Marcus, start at the exact same point. They are the same age, live in the same city, earn $55,000 a year, and have exactly $50,000 in savings. Jake uses his capital for a down payment on a house. Marcus puts his into a total stock market index fund and sets up an automatic $300 monthly contribution. Over 20 years, their strategies diverge completely, yet they arrive at the same destination. Both end up with a net worth between $400,000 and $500,000. Because the mathematical endpoint is virtually the same, choosing an investment based on which one looks richer on a thumbnail is a mistake. Determining the right path requires stripping away the gross numbers and running the full 20-year net math to see what these assets actually cost in terms of time and resources. Success depends on your tolerance for specific types of stress, risk, and the daily lifestyle trade-offs required to manage each asset for 2 decades. Jake's $50,000 down payment allows him to control a $250,000 asset. This is leverage. He uses the bank's money to move 5 times the weight of his own capital. On day 1, the numbers feel like a win. He charges $1,800 in rent against a $1,330 mortgage, leaving $470 in gross profit. Marcus simply sets up an automatic transfer for his index funds. He has no keys, no tenants, and no physical property to show for his investment. The psychological experience is night and day. Jake gets the immediate social proof of a physical asset he can drive past and point to. Marcus is left with a confirmation email and a number on a screen. Leverage provides Jake's primary advantage. If the house appreciates by 3%, that growth is calculated on the full $250,000 value, multiplying his personal gains through the bank's money. Marcus lacks this multiplier. In the stock market, he only captures growth on the specific dollar amount he has personally deposited. While leverage is a powerful wealth builder, it requires taking on hundreds of thousands of dollars in debt, making your financial survival dependent on a tenant's ability to pay. By year 3, Jake has collected over $64,000 in rent. This large green block represents his gross income, but the real-world bills are about to take their share. Property taxes and insurance costs immediately drop the baseline. These are fixed, non-negotiable expenses that erode cash flow every month. Capital expenditures are the inevitable costs of keeping a house standing. Roofs, furnaces, and water heaters have expiration dates, and replacing them requires thousands of dollars in cash reserves. Vacancy is the most sudden drain. 1 month without a tenant means Jake must cover the full mortgage himself, with 0 income. Even minor turnover costs money, from cleaning fees and listing costs to the small repairs needed to make the unit rentable again. After 3 years of these expenses, Jake's actual net profit is roughly $3,000, a tiny fraction of the $17,000 he originally projected. To maintain even that small margin, Jake manages the property himself. He is trading his free time to field late-night maintenance calls and coordinate repairs during his lunch break. Gross rent is a vanity metric. Real estate is a capital-intensive, low-margin business that requires significant effort and cash reserves to protect it. While Jake manages repairs, Marcus has spent 0 hours managing his portfolio. His time remains completely his own. Marcus relies on passive compounding. Eventually, the gains generated by his existing portfolio exceed his monthly contributions, creating wealth while he sleeps. To scale his wealth, Marcus simply types a larger number into his monthly auto-transfer. The compounding curve adjusts instantly, without any additional work. To achieve similar scaling, Jake must locate a new property, secure a second mortgage, and double his operational workload. However, Marcus pays for this passivity through total exposure to public market crashes. This is volatility. In 2008 and again in 2020, markets dropped more than 30% in a matter of weeks. Watching $150,000 vanish into $95,000 is a test of character. Many investors panic and sell at the bottom, turning temporary market drops into permanent losses. Unlike a rental property, index funds provide virtually no monthly cash flow to live on. You are building wealth you cannot easily spend. Jake gains physical control over an asset by sacrificing his free time and liquidity. Marcus secures complete passivity at the cost of his emotional stability during market crashes. At year 20, the two paths converge. Jake has a paid-off house and significant equity. Marcus has a massive compounded brokerage account. Their net worths are nearly identical. Ultimately, your final decision should be based entirely on which specific set of trade-offs you find more sustainable for your daily life. This decision tree maps your constraint, time versus capital. Real estate is for optimizers wanting leverage and tax shelters, treating investments as a part-time business. Index funds are for wealth builders prioritizing free time, who can watch a portfolio drop 30% without flinching. Real estate offers clear advantages in specific scenarios, such as house hacking to eliminate your housing costs, or using 1031 exchanges to defer taxes on gains indefinitely. A 20-year financial commitment must always be based on your own personal numbers, not a headline or a podcast clip. Build strategies around the path you can realistically sustain for 2 decades without ruining your life. That consistency will always outweigh a slightly higher theoretical return on a spreadsheet.